obviously, as you go up this area from cash to real estate, your potential return or your weighted return across all these assets increases. Just to be clear about it, a portfolio with 25% in cash, 25% in fixed income, 25% in equities, and 25 in real estate will have a very, very different return compared to a portfolio that's purely in equities and real estate. And then you compare that to a portfolio that's purely in cash or fixed income. 70% of your returns will be determined or given. So that being said, one of the things that I usually say is, okay, for the guys who are looking at, how do I simplify? What do I do on a day-to-day basis when I say develop a portfolio strategy? So I just wanted to give you some point of difference, whether you are a bond investor or a fixed income investor or an equity investor. You have these gradients. On the left-hand side, I could say that there's passive bond management or pure bond indexing or pure equity indexing. You're actually just following the index. So if anybody knows about index funds, so Jason, I saw you come in. Jason, you have an E-Trade on. Jason, are you there?
Yes, sir. Good
Okay.
evening.
Good evening, Jason. So Jason, I was calling you earlier. Anyway, Jason, you have an E-Trade. Uh, you have call and DPI trade, right? Do you have an index fund? Are you holding an index fund or what? You
Uh, no, sir. Right in the US, no, I don't. I'm not holding an index fund right now. I'm purely in stocks and options,
okay? So Jason is purely
equity
stocks and
options.
options. So he's here. He is active management. Thank you, Jason. Thank you very much. Jason is doesn't really mind following an index. He is choosing particular stocks and choosing particular options. So he's very active. So that's his style. Can somebody volunteer? Can somebody tell me who of you has a index UITF or index mutual fund? Anybody there?
Um, I have served with Phil Equity PSE Index Fund.
Could you open your camera, please? Who is
Me,
this?
sir.
Arjun.
I have Phil Equity PSE Index Fund po.
Why are you doing the index fund? Why are you here? Listen to what Margin has to say. Why are you investing in an index?
Um, like personally, if I would assess myself, I'm really not an active investor, meaning I don't really have an inclination on like technical trading or stock trading. For me, I would rather devote more time in increasing my cash flow so that I have something to invest and let other people manage on my behalf. So I decided to open Phil Equity PSE Index Fund because it just mimics the physics, the Philippine stock index, and it's part of my like long-term goals, part of my retirement fund. That's
Very
how I
nice.
approach
Thank
it.
you, Margin. See, so listen to what Margin has to say. So in short, Margin didn't only talk to you about why he has an index fund. You already have insight as to what type of person Margin is. He's looking forward. To a certain extent, although he does have risk, he, because he has equities, he's not that big of a risk taker. You compare that to Jason, maybe because of their difference in backgrounds. Jason is a lot more aggressive because he's here on the spectrum. Thank you very much, Marjan. And I really appreciate that both of you guys talk because in the middle, this is where I am. I do have some of this. I do have some of this. But in terms of choosing certain indexes, whether bonds or equities, I choose funds that kind of follow the index but have minor mismatches. What do I say by mismatches? And that's the term is actually it's called enhanced indexing. When I was younger, when I was managing a portfolio, I did a lot of this. So let's be clear. When I was managing an equity fund, I would say, okay, I would follow the index, but I believe that I'll give you an insight to how I thought when I was younger. I was a big fan of property. I was a big fan of obviously that's not happening right now. It's a different market. I was a big fan of consumer, which is still working out now, and I was a big fan of banking during some years, even until now. So I would follow the index, but I would wait more on certain areas. Let's say I would wait more if the index was that had 16 or 17% in SM properties. I would put 20%. I would put more. The index didn't have, let's say, certain banks. If it didn't have Security Bank, I would buy Security Bank. Okay? So that's enhanced indexing. On this flip side, dito naman sa larger factor mismatches, if the index has, let's say, stocks ABC, and this has A, B, C, D, E, just to be clear, this probably has A, X, Y, Z. Okay? So it depends on what type of portfolio. If you capitalize, if you're a passive manager, you just want to match a liability or match a benchmark. Active, you want to beat the benchmark. But when you choose a benchmark, oh, before I go on, am I supposed to allow somebody to record? I'm sorry. Herc, am I supposed to allow somebody to record?
Uh, oh, no need, sir. Or are you recording, sir, or not?
No, I'm not. I'm not. But
Uh,
who wants to? Anybody who wants to record?
I think it's
Yeah,
okay.
it's okay.
Margin, sir. I think supposed to say something.
Marjon?
No, no, sir.
Ah, okay.
Okay. Okay. Never mind. Let me just continue with this.
Sir, sorry, question.
Sure.
Can you consider the money market fund an index fund?
No.
Okay. Arvin, is that you? Could
Yes.
you turn on your mic? Turn on your camera so please.
Sir.
Hi, Arvin. No, the money market fund in a sense, remember, either you're a money market fund, there's a benchmark, right? There's a particular benchmark for any fund. If you're a money market fund, if you're a bond fund, if you're an equity fund, generally you have a benchmark. The most apparent benchmark for bonds is you're looking at the before the HSBC 1 to 5 year bond index. So you have all the bonds that you can buy and you compare that versus the benchmark. And then for equities, you have the Philippine Stock Exchange Index. But here's the thing. The difference there is that when you choose bond indices, it's a lot harder because there's a lot more. PSEI, madali. Ano lang sila, they're just 30, right? And then you buy and sell the 30 and you're fine. Whereas if you invest in the bond index in the Philippines abroad, there's hundreds of bonds. And unfortunately, also, some of the bonds that you invest in or that are part of the index are illiquid. So it's a losing proposition. So when you say bond indexing, a lot of people, when you go here, when you look at bond indexing, like if I go back, if you're looking at bond indexing, if you're looking at bond funds, most of us are actually doing this simply because you can purely follow the index. Okay. So money market funds are not really funds, but they're composed of certain treasury bills, certain short-term paper, and they're not all available in the market anymore. So you end up money markets, in my opinion, are enhanced index funds. Good question. Thank you, Arvin. If you have any questions, this is the limitation of Zoom and when I'm screen sharing. But remember, when you're choosing a benchmark, there are several things that are happening. remember that the benchmark is not necessarily the same thing as your portfolio. Diba? Kasi you can say, oh sige, especially when you're doing an enhanced benchmark or an enhanced portfolio, the benchmark has a different market value risk. Because if it's looking at it, let's say I'm usually referring to the Philippine Stock Exchange Index, and forgive me for doing that because it's the most graphic and easy to explain. If I invest in the Philippine Stock Exchange Index, I have 30 stocks. They're probably the most liquid stocks. If I do an enhanced or an active portfolio, I may be looking at the returns of the index, but I cannot be as liquid as managing. I cannot be as liquid. It's harder, right? And since I'm managing a portfolio doesn't have all index stocks, the market values may move more in a more volatile manner. Income risk, whether you're in stocks or bonds, remember, diba, in bonds you have coupons that give you income on a regular basis. They give you cash flows. For stocks, you have dividends. So if you're investing in different underlying investments, if you're investing in different stocks or different bonds compared to the benchmark, remember, the income streams or the timing of the income streams are very different. Again, credit risk is very different. The PSEI, you're dealing with the top 30 names. You may invest in good names, but they're not exactly the top 30 names. And here, remember the liability framework. Because when you choose a particular portfolio, you're actually choosing a liability framework. That's my favorite example. I'll explain this later on. So think about this. If you say that I want to invest in a portfolio that will give me X amount in 10 years, you already have that mindset that that's the liability that the investment has to make up. You have to have X amount at the end of 10 years. So you have to find the right benchmark for that. And it may be different. And the problem is, okay, you find the right benchmark. You have to follow that benchmark. But what if, you choose 2 stocks or 3 stocks or 4 stocks that are different? Then you don't match the characteristics already. So this is actually a big risk. And you may say, if you don't understand, that's fine. We're just starting. But think about this, and this is just a day-to-day example. Part of my job requires that I manage the money of insurance firms in the pre-need industry. So the pre-need industry, being insurance, some of you may be in that industry. Usually the investments are in 10 years, 15 years, or 20 years. So that's what you're thinking, and they're thinking that higher rates, and they're thinking cash flows once or twice a year. That's the liability mindset of the pre-need company. But the problem is, if I'm managing their funds, I also have to understand that sometimes they need short-term liquidity. They also need something short. So while I'm investing in some long-term, I have to invest in short-term paper as well in terms of good governance. So what happens? They're expecting a return of 10. At least a couple of years ago, I'm giving them a return of 7.5. They're expecting cash flows every so often or on particular dates because they're looking at the benchmark, and I'm saying, oops, you have different times where you have extra cash flows. Or oops, you don't have that particular security, so you don't get cash flow on that particular day. So that's liability framework risk. So if you think that choosing a benchmark is easy and it doesn't mean anything, it does. It's a big problem. And if you choose the right one, it's actually very, very comforting. It's very rewarding. So for some people, like Marjon, you say, okay, why do I index? Generally, if you're managing your own portfolio and you're investing, let's say, in an index fund, the main reason is that it's cheaper. These fund managers, if you're indexing, they're practically not thinking. I'm not thinking. I'm just doing it. I don't have to think about extra stocks or bonds that I have to buy. I'm just following the market. So if you look at various websites, various banks, various mutual funds, if they're selling you two funds and one is an active fund, meaning it's not following a benchmark, generally, the fees are lower. Okay, my belief is that over time, because of lower fees and because of research, they generally outperform most active managers. Because and I'll tell you this, as a fund manager who's been doing this several years already, sometimes it's just easier to invest in the index and ride it. It's cheaper, you don't have to think. And if it's a broad enough index, meaning you have 30, 40, 50, it gives you enough diversification. The magic number for diversification, when I was looking at before, which gives you enough, and I think I have to do some more research, but based on the CFA curriculum I was studying before, if you have 8 to 10, 8 to 12 stocks, that's enough. That gives you enough diversification, even if you're not following the broad index. But the more you invest, if you're following that index, then it's broader. Like the S&P 500, that's the stock index benchmark for the US. You're investing in the top 500 stocks in the US. So that in itself gives you broad diversification. So what are the advantages? And guys, take this with the view, because, don't take this with the view that you will be managing your own portfolio, because that's what I want to do. This is personal finance. Okay, but I'm taking this / portfolio management approach because I realized when I was taking notes as to who you are, a lot of you, but here's the advantage and disadvantage. If you really know how to manage a portfolio, please feel free. But for others who are coming in, I would be remiss if I didn't teach you what are the pros and cons of doing it yourself and trying to follow an index. So if you're trying to manage an index, or you're like me, you're trying to replicate an index, the good thing is you have very low tracking error risk. Okay? So what is tracking error risk? Let me just show you. Think of this. This is tracking error. If your benchmark does this, okay, and then if you're investing, let me do this, and this is your portfolio. The blue is the benchmark. The red is your portfolio, or at least your first portfolio. This is your first portfolio. And then this is your second portfolio. Okay? So blue is the benchmark, red is the second, red is your first portfolio, pink is your third on the screen, and which has a higher tracking error. Without me explaining what tracking error is, can somebody volunteer? Who's that?
Hi, sir.
Aaron. Hi, Aaron.
Hi,
Okay.
it's here. Without the explanation, sir, and just looking at the picture, I think the red one has the lower tracking error because it follows the blue one than the third, than the pink line, sir.
Thank you, Aaron. Yeah. Metrobank trained you well. That's true. Because if you look at this, tracking error is basically you're trying to track the benchmark. The higher the difference between the benchmark and the fund, the higher the difference. So take a look at this. You see the space. Let's look at the time period. You see the space between the blue and the red line? I would describe that as the tracking error between the benchmark and the portfolio. Just simply put, we'll talk about it more later on. But look at the pink line. Between the pink line and the red line, that is a tracking error. That is a disparity between these two. Okay? If you have any questions, please just ask me. So if you do a benchmark approach, theoretically it's no tracking error, but it can be difficult. As I said, with bonds, there are many issues. There are some bond indices that there are about 50 to 100 issues. And then there are some bonds that are illiquid. And of course, no matter what you do, if you're trying to replicate a portfolio, or if you ask somebody else to do it for you, it's never going to be equal to the benchmark, simply because you have management fees and you have transaction costs. You have brokers, because when you buy and sell a particular security, you have brokers and they will charge you for that.
Sir, sorry.
Yes, please.
Tama po, no? The benchmark is the index or the specific index that you've chosen.
Yes.
Kasi sometimes, well, based on the experience, sometimes for example, PSEI is down, like now, pero some second liner stocks are up. So, parang ganun. Parang yung benchmark is not the same, I guess.
Yeah, actually, I get what you're saying. Actually, the benchmark is not appropriate, diba? Because your benchmark is the Philippine Stock Exchange Index, and then you're buying a second liner. So go on, sige, please.
Yun yung explanation, sir. You're buying second liner stocks, pero yung index itself is going down. I guess lately lahat bumababa, even yung second liner stocks. But I think there was a point last, I think, few weeks ago, na the index went down 6.5, 6.6 ata or 6.7, but second liner stocks are going up, like Tito, Merrimart, and all those second liner stocks.
Exactly.
So yung disparity is really high.
Yeah, I agree with you. See, that's why having an appropriate benchmark is very important, because you cannot have second or third, or the third here in the Philippines is, for the third, fourth liners, the basura, and then you have I suppose you don't have any more appropriate index except for the PSEI index. But that being the case, it doesn't really reflect what you're holding. Tama, thank you. So that's something that you have to understand. Sometimes benchmarks, because you have no option, but it doesn't really reflect, like what he said, the risk and the possible return of what you're holding. See, this is exciting. Enhanced indexing, and I'm a fan of this, but I don't really, for those guys who are coming in for the first time, I don't espouse it yet. This is actually when you're managing your own portfolio, and when you're managing it professionally. So what you're doing is, like what I said, you probably buy the index plus minus a few stocks or bonds that you think will do well. Cell matching or stratified sampling. You know what it's done? It divides the index into subcategories and selects issues that represent, one cell or the other. You know what? This is just what it looks like. Oh, let me just finish this. Proprietary multi-factor models sometimes look at particular risk factors. I've done both of this, but take a look at this. And this is something very, very simple. Okay? Let's just say I have an index, and the index has, forgive me, a property, banking, and then consumer. The index, so let's say the I, has, just for is 5 stocks in property, 5 stocks in banking, and 5 stocks in consumer. If I were to index, I would just go 5, 5, 5, exact. If I were to do enhanced, I can do this. Since I'm looking at property, I can say, okay, I want maybe the 3 that will do very well. And this is something that I've done. I'm just sharing you my particular experience. Okay, there's 5 in the index. I think there are 7 who will do well. For consumer, 5, no, maybe not. Maybe I'll just do 2. So here, in terms of enhanced indexing, you can see that the names here and the names here may be the same, but I've cut out 2 names. Here, the names here are the 2. Here, I've cut out 3. If you really want to say active management, it may be like this. So 5, 3, maybe 3 also. And then it could be 2 here. And then it can be 0. And then there's another sector, let's say tech. There's nothing here. But all of a sudden, I'm 7. I have 7 here. In a nutshell, that's how different it is from index to enhanced to active. Okay? And it's not just done for equity funds. This can be done for bond funds. I'll tell you, sir, paano yung government security? Same thing. You can probably have a government security. You have a government security allocation. And then here, if the index has 2, then you have 2. You probably have 3, probably have 1. Same thing. Any questions so far? Enjoying this too much. So